To Salone.SRI, welcome to this conference, What Investor Needs to Get to Net Zero. This conference will be held in English, so for you all that are here in Palazzo Selline, there are headphones outside the room, and for those who are following us on the platform, on streaming, you can choose the language, English on the platform if you desire to have the translation. So let me introduce myself. I'm Elena Bonanni. I'm partner of ETicaNews. Today, I'm not alone, just our speakers are far away, so they are connecting in remote. We have with us Marion de Marcillac, Executive Director, ESG Products, MSCI. Laura Segafredo, PhD, Global Head of Sustainable Research for BlackRock ETF and Index Investment Platform. And Maja Zandbergen, Head of ESG Integration, Robeco. So thank you all. I think I can see you later on the screen now. Welcome. Okay, so in this conference, we will discuss about what investor and other capital markets participants will need to bring to net zero, to bring sustainable investment to scale and to thrive in a net zero world, which means talking about data, which means talking about disclosure. Which data do investors need to assess the resilience of the climate change of every asset so they can value the risk and opportunities across their portfolio. And about disclosure, this is also a relevant topic because there is the need of a common language on corporate climate disclosures. And therefore, for companies, there is a need to make reaching net zero emission a central part of their business strategy. So during this discussion, we will talk about these issues, but before we go to the discussion, I ask Marion Marcillac to introduce us to this net zero revolution. What is your view of the path we have ahead?
Thank you, Elena, and hi everyone. It's great to be here. Wish I could be in Milan as well. So let me provide maybe some context in terms of that this concept of net zero. I'm assuming most of you are familiar with it now because it's been, you know, a buzzword for more than a year now. But basically, this concept is coming from. So the Paris Agreement goal is to limit, you know, global warming well below 2 degrees, preferably to 1.5 degree, compared to pre-industrial levels. And this 1.5 objective was really raised by a number of countries and island countries in particular, and stakeholders during COP21 in 2015. And so in October 2018, the IPCC, so the body of climate scientists that generate research and analysis that inform policy decision and discussion at COP, published a report called 1.5 report. And that was really the first one that was published then. And what the report shows is that, you know, according to the IPCC, we're currently tracking towards a world that will be at 3 degree warming by 2100. In all the pathways that limit warming to 1.5, which you can see in this graph, like all the different lines, you can see that the CO2 emissions fall substantially around 2030. So that's, you know, one of the deadline in terms of when the emission needs to drop really significantly, and then they reduce to net zero by 2050. More or less. So basically what it means is that when you say, you know, being net zero by 2050, this is very much saying that you want to be aligned with the Paris Agreement and that you're targeting, you know, global warming well below 2 degrees and preferably 1.5 in 2100. So just wanted to provide a little bit background on this. Now, the other thing that I wanted to mention is that, you know, at MSCI, we hold ourselves to the same standard that we use to assess issue, climate risk assessment, and also we published a TCFD report last year, and earlier this year we committed to net zero before 2040. And one of the things that we also did is we published a call to action on the role of capital in the net zero revolution, and basically calling on all stakeholders to embrace and accelerate the revolution away from fossil fuel and toward a net zero economy. And as part of that process, we are also publishing on a quarterly basis on our website what we're calling the net zero tracker. And the MSCI Net Zero Tracker really indicates the collective progress of listed companies towards global climate goals. So it offers an objective gauge, if you want, of companies' contribution to total carbon emission and their progress towards a net zero economy. In the last publication, which was from October, we estimated that listed companies will burn through their share of the global carbon budget for keeping temperature rise below 1.5 degrees by November 2026, based on their emission as at the end of August. Basically, today, listed companies' annual estimated emissions were 11.1 gigatons of direct greenhouse gases, up from 10.9 gigatons at the end of May. So this is increasing. And the only way to really buy more time is to cut net emission faster. So that's just a little bit the background in terms of where we are at the moment. The other thing that I wanted to mention is there is a lot of momentum putting pressures on asset owners and asset managers to really, adopt net zero targets in their investment process. And those pressure points are coming a little bit from everywhere, starting from regulators. Of course, you have, the Task Force on Climate-Related Financial Disclosure that published some a framework in 2017, which they did update earlier in the lead to this COP, but there's also a number of other initiatives, if you want, that are coming from central banks. So the Network for Greening the Financial System is regrouping a large number of central banks, and they're really focusing on scenario analysis, climate scenario analysis, and stress test. And also a number of disclosure regulations that are just asking for more transparency from fund managers. But the pressure is also coming from alliance, if you want, and the first one that was created in 2019, the Net Zero Asset Owner Alliance, is really one of the leaders, if you want, in terms of coming up with framework and protocol and then commitment for those signatories to really set net zero targets and publish that and then track progress. And obviously all of those net zero those asset owners are, then expecting from their managers to implement that as well. So that also has a trickle-down effect. And then, so you have similarly the Net Zero Asset Managers initiatives, which has a growing number of signatories, and those asset managers have come up with their own commitment, if you want. And one of this, all of those Net Zero Alliance are now regrouped under what is called the G-Funds, and that's something that Mark Carney in particular has been carrying and pushing a lot. Let me provide a little bit more details on the Net Zero Asset Owner one, because one of the things that was really useful is that they published a target setting protocol earlier this year. And what's interesting to note is that the four key components, if you want, of what they're focusing on. The first one is engagement targets. So, for us to be able to meet or to reduce global warming, we need all the companies to transition, to come up with their own commitments and all of that. And so the engagement from the investors themselves is highly important. And so that's one of the key area in terms of being able to have engagement targets and having discussion with those issuers that are the largest emitters or the ones that are just not transitioning fast enough. The other action point that we're seeing is really decarbonizing portfolios. So basically reducing the footprint of some portfolios, focusing on listed equity first, and then corporate debt as well, but then also real estate, and then there'll be a number of other asset classes that they are recommending. Then there's some more sector specific action that can be taken, and in particular with sectors that are either large emitters or really hard to abate in terms of transitioning. And then last but not least is also being able to allocate more capital to those companies that are providing solutions. So what they're calling the financing the transition target. So, shifting the capital to those companies that are developing solution products that will help either, in mitigation or adaptation to climate change. One thing that I wanted to mention is that the Net Zero Asset Owner published a status report a few weeks ago, and we can see that close to 30 of their signatories, if you want, have really come up with some targets where they are committing to reduce the emission of their portfolio between 25-30% by 2025 across 3 asset classes. So those are already like pretty significant commitment. From an asset manager perspective, the implication has, it has implication at different level. And one of the things that the asset managers need to look at is issuer level, portfolio level, and then total entity level. And then at the issuer level, one of the things that we wanted to, that I wanted to highlight as well is it's really important to be able to understand where a company stands and what type of transition plans they are having, and whether they're actually on the path to be aligned with trajectories that are aligned with 1.5 or 2 degree warming. And so one of the things that we have introduced recently is first an analysis of companies' targets. To date, the targets are disclosed very disparately. It's all over the place. And so one of the big exercises is being able to normalize this and make it useful for investment decision in terms of like understanding whether a target is ambitious enough, what scopes does it cover, and then how comprehensive it is. And then you can, from that on, you can then project companies' future emission. And that's a very important aspect if you want to be, forward-looking in your assessment. The other components that we have introduced recently is the implied temperature rise. And that's something that you can also find directly on our website, msci.com, where we are making transparent the implied temperature rise of all the companies within ACWI universe. Basically, I'm not going to go into the details of the model, but the idea is really to provide an easy to understand metrics like the temperature, which indicates right away whether a company, based on its allocated budget, how much it owns in terms of the remaining budget to be within a world of 1.5, and how those their own emissions are projected to grow or decrease if they have targets, and comparing this and just being able to assess how the company is aligned in terms of temperature, making the assumption that the whole world would behave similar to that company and use more than in budget or under its budget. So that's also an important aspect and a metrics that is easy to communicate on and track progress. And then finally, at the portfolio level, I think one of the different things that investors can do is indeed take stock of what the companies are doing. But then if you have made a commitment of, let's say, you want to reduce your portfolio by 50% from where it's at in 2019, and with an annual decarbonization of -7%, by the way, which is one of the requirements from the European benchmark regulations, then you need to take stock first of what the companies are doing, right? What are their own commitment and whether that is sufficient to reach that goal. But what we can find here is that today it's not. And basically, in addition, the companies will need to, the portfolio manager will need to decarbonize, beyond what the companies are pledging, if you want. And so that can be done in different ways. You can reduce your exposure to the companies the most at risk. You can allocate more to the solution providers, but basically there's different ways that can be used to use this at the portfolio level. Okay, one important thing, of course, is that once you've done this, you need to be able to track progress and communicate that to your stakeholders, right? Whether it's regulators, but also more importantly, being able to add this to your narrative and your product pitches, if you want. So that's an important aspect as well, where we can support our clients. I'll finish this on the last slide. To Helena's point, I think data is obviously key to everything in the net zero journey. And with increasing regulatory disclosure requirements, we can expect that the quality and the volume of the reported data is going to improve. But it's still important to have ways to make sense of the data and to normalize it so that it can actually be useful for investment decision, and be able to fill in the blanks as well when companies do not disclose, which is still very much the case even for footprint data, right? There are still a large number of companies that do not disclose their scope 1 and 2 emission. And so basically what we have at MSCI in terms of the data is providing, all those building blocks that can help our clients in this journey, and whether it's being able to focusing on minimizing the transition risk of climate, capturing the opportunities, minimizing the physical risk, so the direct impact of climate change, and then really aligning with temperature, which is something that we're seeing more and more as a requirement from regulators, and also being able to assess how companies are transitioning is a very important point, because you want to be able to use this to inform engagement and investment decision. Okay, those are really the background points that I wanted to make, and I'll stop here and pass it on back to you, Helena.
Thank you, Marion, and for your clear presentation. So in your slides, you mentioned some of the asset managers that are part of the Net Zero Asset Managers Alliance. So I see both Robeco and BlackRock. So I would like now to turn to them to understand what are asset managers doing to respond to this net zero revolution. Let us start with Maja, Robeco.
Thank you, Elena. Good afternoon, everyone. It's a pleasure to be here. I'm going to try to share my screen because I want to show our net zero roadmap. I hope that will work. So at Robeco, we are indeed one of the founding members of the Asset Managers Net Zero Initiative, and we really want to contribute as an investor to a net zero in the real world. I think that's the first important thing to mention. So it's not about only decarbonizing our portfolios, because if we want to do that, we can maybe do that more quickly. But of course, really decarbonizing in the real world, that is what it's all about. And how can we then contribute as an investor? Well, we see 3 levers that we can pull, and we have defined 6 actions in our net zero roadmap. So the first is to decarbonize our activities. Action 1 is then to decarbonize our portfolios, and I'll come back later what that looks like. And second is also to reduce our own operational emissions. And then you have to think about the data centers that we use, which are a big part of our operational emissions, but also our travel. And this is something that is difficult to really change, but also there we've set a -7% target year on year. So in terms of CO2 emissions. So we're not only asking companies to decarbonize, but we're also looking at our own operations. The second lever is really accelerating the transition. And I think Marion really explained very well that there are very little companies at the moment that are really aligned with a below 2 degree scenario. And we, as an investor, can really engage with those companies and try to get them to set relevant targets. And again, I will come back later on what that exactly means. And it's not only about companies, because if you're a big investor in government bonds, it's very difficult to decarbonize your portfolio, because in the end, it's up to the countries to decarbonize their economies. So again, we need to do more with engagement. And this is a new area that we are working on to really engage with governments as well. And then the third lever is really promoting climate-aligned investing. First of all, to working with our clients, because we've set a target to become 100% carbon neutral in 2050 for all of our assets. So also our clients need to make steps. And the 6th action is also to collaborate in those industry initiatives that also Marion showed a few already. So what does that look like in terms of a timeline? Well, we didn't start this year, already start earlier. Of course, we're engaging with companies on climate since 2008. Our first climate change policy we developed in 2017. But really going forward, what does our decarbonization roadmap look like? Well, we have set targets to 2025 for 40% of our AUM assets under management, where we want to reduce our carbon emissions per million invested euros by 30% and our operational emissions by 35%. Why 40% of our assets? Well, those are all the funds that we have discretion over. We need to work with our clients that have mandates with us to also work with them to see if they want to incorporate this net zero targets in their portfolio. So this is the assets that we have discretion over, and this is only equities and credits. It's excluding sovereigns because of the issue that I mentioned earlier, and we're doing more engagement there. We will review these targets each 5 years. Of course, we will monitor them on a quarterly basis. This is a organization-wide target, and we will monitor that on a quarterly basis, but we will review our target setting every 5 years in line with the ratchet mechanism that is being used. This is our net zero roadmap. When we come look at engagement, we have looked at our 200 highest emitters in the portfolio based on scope 1, 2, and 3. And then we've tried to assess, just like MSCI is doing, whether or not they are aligned with the 2-degree scenario, whether they are aligning, whether they are committed to aligned, or whether they're not aligning. And the issue here is that for 42% of the companies of the top 200 highest emitters, we actually do not have enough data and enough transparency to assess whether or not these companies are actually aligned. So I think that's an issue that we need to work on as an industry going forward. So that, in a nutshell, our net zero roadmap and our ambitions for the coming years.
Thank you, Marzia. And I would like to ask the same question to Laura Segafredo to understand what they are doing to respond to this net zero revolution.
Yes, thank you so much, and thank you for having me this morning. And apologies, it's a little dark here because it's still very early, although the sun's coming out now. I'm in New York City. So a couple of things I wanted to say to sort of set the stage before I talk about the commitments that we made publicly earlier in the year and what's to come before the year ends. So we have said pretty publicly, as you know, that our view is that climate risk is investment risk, meaning climate is already affecting portfolios today, and if you ignore it, you do so at your peril, and basically that means you're missing something as an investor. So that's number one. And in particularly, we think that there are 4 main factors at the heart of how climate change is already impacting portfolios. The first is obviously physical related risks, and that's something that's already very clear to everyone, that even in a world that's warmed by 1.1 degrees above pre-1850, which is where we are today, we already see the manifestations of climate change. So that's something that clearly impacts relative asset values, and we need to pay attention to that. So that's number one. And then there are other transmission mechanisms. So we clearly know that innovation is vital. We see that the cost of renewable energy has decreased so much over the last decade, beyond every possible wild expectation. I would know. I used to be in academia, and my job was to really think about decarbonization scenarios. And let me tell you, nobody in that space has even imagined that the cost of renewables would come down by 90% over the last 10 years. So, in fact, the average scenario projection missed that cost trajectory by about 6 times. So it's really interesting. So clearly technological innovation is playing an important part. The second thing is that we think that government policy and regulations will play an increasingly more important part. Clearly, we just closed on COP26 in Glasgow. We talked about that. We think that there is a sort of heightened focus on governments and what they're going to do and the policies they're going to put in place to really meet their commitments and the pledges they made. in the international negotiations. And the third is really consumers driving with their choices, voting with their wallets, as they say here, choosing companies, products from companies, services from companies that are making strides to reduce their climate impact and to align themselves with sort of global ambitions around containing climate change to a certain threshold, the one specified by the Paris Agreement. And so all these factors we think will influence asset prices and will impact investors and their portfolios. I would also emphasize that all this means that there are also opportunities in this transformation that we're going to witness in the next 30 years. I think the risk angle is emphasized a lot, but I think that as an investor, I can't really not talk about the opportunity. There's going to be a massive capital reallocation to the tune of $50 to $100 trillion in the next 30 years, perhaps even more. And with that come a lot of opportunities. So you gotta be in the right place. Second point I'll make is that clearly there's a role to play for financial institutions. That's what we're talking about today. There's a lot we can do. And I think that what's really interesting, sort of witnessing the evolution of the conversations in the international sphere around climate is that up until 5 or 6 years ago, even up until COP21 in 2015 in Paris, this was mostly a conversation among governments. And now looking at the Glasgow COP and sort of how it played out, I would say that the role and the participation of the private sector certainly is super important, and we've seen that a lot, but also obviously civil society is becoming increasingly present and increasingly vocal, and I think that that focus will really put some pressure on policy and financial institutions. So that's really important, and companies. So that's the second thing. And then the third thing that I'll say is that we very much think that we're at the beginning of this transformation. We're at the beginning of even thinking about what net zero means, what this net zero carbon by 2050 objective means for us as investors, as fiduciaries to our clients. What does it mean for portfolios? It's important that we understand that, as my colleagues have said just earlier, driving emissions out of a portfolio is not the same thing as driving emissions out of the real economy. There's a difference between accounting and physics. And so that's really important, and it's important that we don't overstate the importance of just simply rejiggling a portfolio so that its carbon emissions come down. And I think that that's very clear in the frameworks that came out that sort of tried to set some definitions around what net zero investing actually means. So the Net Zero Asset Owners Alliance, Marion talked about that. The Net Zero Investment Framework by the Institutional Investors Group on Climate Change. Similarly, they basically agree that net zero portfolios are not simply portfolios that take out certain sectors or the worst performers in those sectors. It's really about more than that. It's about having a clear path for these companies in the portfolios to actually reach net zero emissions in the real world, in the real economy, within the time frame that we need. So that's another important part. Now, having said that, and I'll talk about metrics, and obviously Marion gave a great intro on that, and setting some sort of boundaries around what it means. What are the metrics that we can use to define net zero and alignment in portfolios? That's a really important piece of the conversation. Again, we're at the start, we're at the beginning. Some of these metrics are more established, some of these metrics are more nascent, but I think we'll talk about that in a little bit. Let me talk about our commitments that we made earlier in the year, and that throughout the year we've met, and there's still some things coming early in December that we've committed to. So the first is around transparency. So one of the things that we have committed to is we have committed to providing our clients with more data points around the sustainability performance of their portfolios. And so if you look at iShares Fund today, you'll see that in every single fund page you have a bunch of sustainability metrics. They're provided by MSCI. We look at not just ESG scores, but also at carbon emissions, for example, or carbon intensity of portfolios. And there will be more coming. We've committed earlier in the year in January to publishing metrics around the alignment of portfolios with these global climate goals. And so that's something that we're gearing up to do before the end of the year. So that's a really important step. The second is around providing our clients with choice. So we have launched more than 30 new products this year. Our sustainable suite in iShares is more than 120 something products. And that's just because we want our clients to have the option to incorporate these considerations in their portfolios in different ways, across a spectrum, a menu of choices, if you will. It can range anywhere from screening out certain sectors or poorly performing companies to optimize portfolios to reach certain goals that can be decarbonizing the portfolio or meeting a certain ESG score. Or best-in-class, so-called best-in-class strategies that really emphasize overweights on the better performance. So it can be a variety of different things. But basically, to date, our objective is to provide the building blocks to investors to substitute for traditional exposures with ESG sustainable or climate exposures in their portfolio. So that's really important. And we see that obviously institutional clients really want that, but I think that goes way beyond institutional clients. We see that in pretty much every segment of our client base. And then the third lever that's really important is engagement. Obviously, we're a large index provider. Clearly, iShares, ETFs and index funds are our bread and butter. And so as broad-based indices will continue to include all sectors of the economy, including the ones that contribute the most to greenhouse gas emissions and climate change, we need to find a way to carry those companies along. Again, in this concept that net zero portfolios and net zero world are not the same thing, but we need to make them the same thing, right? And so we have unveiled the heightened scrutiny framework earlier this year, where we have committed to engaging more heavily with the companies that are responsible for the majority of emissions. Just as a reminder, today in a traditional sort of market cap weighted index, 5 to 10% of companies basically drive 80 to 90% of emissions. It's really quite striking, actually, and it's only becoming more concentrated. It's really interesting. And so we have committed to that framework, and we have engaged heavily with these companies. As you know, we require disclosures under TCFD and SASB frameworks, but we also are working with companies to ensure that they have a plan. They have a plan to thrive and continue to exist in this transition, and they understand what needs to be done strategically within their own business to actually navigate and potentially participate in this transformation. So that's an important one. And we have published reports on this, of course, in our engagements, and there's been some sort of high-profile votes and efforts this year, obviously, but it's very much something that we'll continue to do in the future. And I'll close there.
Thank you, Laura. And in this path to net zero, what are the main hurdles you see, Maja?
Yeah, again, maybe I'll share a few slides just to guide my my presentation. 1 second. Yeah, so there are a few hurdles that we see when it comes to specifically to data. I think that is one of the most mentioned hurdles that I hear. And what are the challenges? First of all, the characteristics of the carbon data, for example. I mean, it takes about 2 years to get the data and then to report on it, and then when we get it in our system. So it's really a very backward-looking metric. And there's no link, and we already mentioned that, with the transition readiness of companies. So that's one important thing to really remember when you talk about decarbonization of portfolios. The other thing is double counting. If you look at a bank, a utility company, and a real estate company, a bank that rents a building and the electricity that it uses is reported as scope 2. Scope 2 for them. For the utility company that provides the electricity, the carbon emissions that come out of that is scope 1 for the utility company, and then for the real estate company that is renting out the space to the bank, actually the carbon emissions of that energy use is reported as scope 3. So there's a lot of double counting in the whole cycle, in the whole value chain when it comes to carbon emissions. Now, it's an issue if you look at the absolute carbon emissions. It's not really an issue, we think, when you report over time, because all these companies need to decarbonize. And I think what Laura said earlier, 5 to 10% of the companies are providing a big part of the emissions. that's only if you look at scope 1 and 2. If you include scope 3 emissions, so what happens when you start using the products, I think it's going to be much more. The clients of those big emitters also need to decarbonize, otherwise, we're not getting anywhere. So I think that's also very important to realize, the whole value chain of that carbon emissions. It's not only the worst of the worst that need to decarbonize, but their clients need to decarbonize as well. And then the third one is when it comes to corporate emissions, we really see different reporting principles. We see different scopes, and we also see a lot of missing data still. So it's very important, if you start working with the data, that you really get a good view on what data you are using. And actually, this is the area of our Center of Expertise on Sustainability that's growing the fastest. It's the data scientists that really need to dig into the data and make sure that we work with high quality data, because it will have impact on our portfolio management going forward. So it's a key element. And how do we do that? Well, we selected a data source and a data provider that we believe fits very well with the way we look at things and the challenges that we mentioned. And we fill in the missing gaps by using our own approach. We focus on as a numerator on scope 1 and 2 only, because that's where we have the best view of the data that is really that we find that's really good, and we're really researching scope 3, but we are reporting on all 3 of those elements. And then on terms of the denominator, and I think I agree with Laura that climate is very important when it comes to making investment decisions. So it's all integrated in all of our investment cases that we make for all of the investment decisions that we make. But when it comes to decarbonization, we really see that more as an impact. So we want to make sure that as an investor, we are aligned with a below 2 degree scenario. And that's why we are using an enterprise value as a denominator, because we believe that we want to be held responsible for that part of the company, of the market cap and the value of the debt that we are actually financing as an investor. So that's why we use that metric. And then what is next? It was already mentioned as well, forward-looking elements, climate analytics. We are working with the Cambridge Institute of Sustainability Leaders to also look at the temperature scores and how can we do that in a good way. And we are also collaborating with the PRI on the policy response project and working with them to help, again, investors look at what impact what do policymakers need to do, and what impact will it have on our portfolios. So these are some of the challenges and the way we at Robeco work around them and how we take them into account in our investments.
Thank you, Marja. And now I ask Laura if she would like to share with us what she views as main hurdles in this path.
Yeah, of course. So, of course, I agree that data is the #1 thing. I would say, like, on the sort of bright side, we are making a lot of progress in terms of getting better quality of data when it comes to climate performance, but we're still at the beginning of a journey, as I was mentioning earlier. So the first issue that was also mentioned is that when you're looking at the most commonly available metrics for, let's say, carbon performance, they're typically backward-looking metrics, such as greenhouse gas emissions or emissions intensity. When you're thinking about the reporting cycle, right, even as we see more and more companies reporting, about 10,000 companies reporting into CDP, I mean, I think that right now on scope 1 and 2 emissions, we've made really good strides over the past few years. But still, when you look at this data, you look at a snapshot of a company basically 2 years ago. If you look at what the most recent data point on emissions from most companies in most broad indices, it's from pre-COVID, basically, because that's a reporting cycle. And so it takes a long time for that data to really become current. And I think that that's a big part of the problem. So that's why today there's a big focus on these more forward-looking metrics that take into consideration, of course, the starting point of the company and the sector and the region where they operate, but also tries to make an assessment about what's the trajectory of that company in terms of emissions, and is that trajectory compatible with the net zero in 2050 scenario or not? Is the company overusing its fair share of the budget, let's say, or underusing it? And so I think that's a really interesting question, but it's one that obviously opens a lot of other problems around modeling. You need to make a ton of assumptions clearly, and I would say right now we're at the beginning of that, and it's really more of an art than a science. And there's certainly been some really good work that we've been part of and contributed to, including the portfolio alignment team within the TCFD that was led by David Blood, that published a couple of reports in the last year around this concept of implied temperature rise, and also more practically, what are the actual decisions you need to make and how to build a robust metric. So that's a really important one. And then there are others. I think that another really, really important one is how basically if issuers have actually made specific commitments around their emissions coming down, and if they've done so under a credible framework. So for example, the Science Based Targets Initiative has been around for a few years, and they've been really the first ones to sort of put out some frameworks to companies to help them figure out what it meant for a utility, for example, or for an automaker to have a trajectory of emissions that was in line with this net zero by 2050 scenario. And so we've made great strides there. In fact, the portfolio coverage metric, so-called, meaning percentage of companies in your portfolio that have set targets under a credible framework, that's also a way to measure portfolio alignment under the frameworks that we mentioned earlier, like net zero asset owners or net zero asset managers initiative. So that's an important one. The other big hurdle, though, that I'll mention is that, let's just be honest, the world is not progressing fast enough towards that goal in the real economy. Again, I just bring it back to the real world, like bring it back to the world where emissions actually affect the atmosphere, not just the portfolio world or the accounting world. So we were just talking about COP closing in Glasgow, and it's, you know, it's good news in a way, right? If you think that about where we were in 2014, we've certainly made a lot of progress. In Paris, before Paris, the world was headed towards 3 to 4 degrees of warming, maybe about 3.5, let's say, on average, according to the different models. With Paris, that number came down by almost a full degrees. We were on track for 6 to 7, something around that. Before Glasgow, in terms of policies and pledges, etc. And now after Glasgow, that number came down a little bit more to maybe 2.4 degrees with the pledges, but it could actually be below 2 degrees if the pledges are fully implemented in a sort of most optimistic scenario. So we've certainly made some progress, but the reality is that if you look at, you know, it's easy to make pledges out to 2050. It's much harder to say in 2030, this is where I'll be. And I'll have reduced my emissions by 45%, which is what, in theory, the world needs to do. Even looking at the Glasgow pledges, emissions will actually continue to grow to 2030 by about 13.5% or so. And so we are just not on the right path today. And so I think that the difficulty here is to put the world on the right path so that we have enough companies to put in our portfolio so that we can support this transition by really investing in a broad market, with the market transitioning to that end goal. It's relatively easy to figure out which companies are already on an alignment path today, or, you know, doing the right thing, or green investments, but it's just hard to really understand, especially in the hard to decarbonize sectors, how can we actually ensure that we carry the real economy with us. So I think that that's a really big hurdle. MSCI, when they published their most recent figures on their net zero data, I think, Marion, correct me if I'm wrong, but I think something around 55% of companies in the ACWI are not on a 2-degree or less trajectory. Yep. So that just makes it hard to build portfolios around that unless you take big tracking errors, basically big amounts of active risk, et cetera. And we all know that the broad base of our investors don't have a big appetite for that. So I think that's the difficulty.
Thank you, Laura. Marion, data is a critical issue. And what is, in your view, main hurdles, main obstacles from this point of view?
I think there's different elements to it. Obviously, the first one is having data that is disclosed, right? So making sure that there is more required disclosure from issuers, and we're definitely seeing this in some, regulations in the UK and a number of other countries as well. So we can expect that there will be more disclosures, but one of the really important point is that this data needs to be disclosed in a homogeneous way, right? And being able to make it comparable, consistent, and that's where we it's still quite challenging. So if you're looking at the target data, so how the companies are committing to reduce their emission, at this stage, the data is disclosed very disparately. Like it's and sometimes you're just missing, sort of like basic information to make use of it. So if you're disclosing a target, you need a baseline year, you need an end year, and then you need a percentage, and you need to clarify whether it's intensity or absolute and all that. And sometimes when we're looking at the data, we cannot use it because we're missing some of those key elements. So I think what's really important is to have a set template for what companies need to report on, and that will help, I think, everyone just making sure that it's comparable and it's you comparing apple and apple and not something different.
Thank you. And what do you, as asset managers, expect from companies for disclosure in this scenario?
Yeah.
Whoever.
Shall I take it? What do we expect from companies when we engage with them on climate? There are a few key elements. Indeed, we want them to implement the recommendations of the Task Force of Climate Financial Related Disclosures as part of their mainstream financial reporting. So I think that's important when it comes to reporting. We also want them to have, and it goes much more beyond reporting, by the way, we also want them to have a climate-related, very strong governance framework that articulates that the board is accountable and has oversight over all the climate-related issues and the climate-related strategy of the company. And we want them also to integrate climate risk into their management, risk management framework, both on transition and physical risks. And then lastly, we want companies to really take action on decarbonization, focusing on the implementation of measures and also the actions to reduce greenhouse gas emissions. And preferably, it was already mentioned, this is science-based. It is tracked and monitored over time, and companies are transparent on the progress that they are making. And I think for us, those are say the four main elements that we expect from companies when we engage with them on decarbonization. And to give an example, we work together a lot under the Climate Action 100+ umbrella, and to further progress at the big Italian energy company, we jointly were successful in getting a board member elected on a board that really had a lot of knowledge when it comes to transitioning to a more let's say less carbon intensive business model. And so I think as investors we can have an impact, and we can also expect from companies that they are transparent, that they set targets, and that they have a very clear governance around climate.
Laura, would you like to add something on this point?
Very
you both
similar.
mentioned engagement as well.
No, very similar. I mean, it starts with reporting. That's sort of a minimum baseline at this point. I think companies need to report on their climate-related risks and opportunities under standardized frameworks, TCFD preferably. And also, we recommend SASB on the materiality assessment of different sustainability risks. So those are the two that we mentioned. When we talk to companies. And then of course we are, like I said, engagement is at the very core of what we do, and it's clearly very important for the index business, because exit is not often a choice that's available to us. And so it's really important that we engage with companies and that we have productive relationships with companies so that we can Again, pressure disclosures, that's really important, but also make sure that there's the right governance in place to take into consideration the transformation that we're undergoing, the vast capital reallocation that we're going to witness, et cetera, so that companies are prepared, they have a strategy in place, and they have competent boards and management that can enact those strategies. So that's really key.
Thank you. I would like to end up with a question for you all. And in this salone.SRI, we talk about ESG identity, and also greenwashing is a big issue. How do we recognize real decarbonization, where greenwashing is hiding, because there is this problem of data and that is critical for transparency and for disclosure.
Maybe I can start. I mean, I wouldn't say that, you know, greenwashing is necessarily something that is intentional, but it's really coming back to my earlier point. Like, we need framework to disclose so that the data remains comparable, and that you're not, you know, talking about something that is completely different from what you're supposed to be talking about. And so that's just, you know, going back to some template for reporting and all of that would avoid this type of greenwashing.
Yeah, maybe I can comment. Marion, I agree. Greenwashing is often used, but it's not always intentional, I think. And I think it's sometimes also a lack of knowledge and experience. So I think if if you're looking for a new value manager for your fund, you're not going to look for someone that has just started yesterday doing value investments. It's the same with sustainable investing. If you're looking for a partner on sustainable investing, you have to find someone that has a lot of knowledge and experience and is able to innovate and generate new products, because the world is changing quite rapidly. And so to avoid unintentional greenwashing, so to speak, so really find a good partner. And then if we want to talk about greenwashing, I think for me there are a few important elements. One is that if you only do take action on a small part of your business and not on all of the assets that you have, or at least a big part of your assets, then I mean, what is that worth, right? Although I have to say, if we measure impact and outcomes, for example, avoided emissions, we always only calculate based on the amount that we invested in a company, and then how much does that company contribute to avoiding CO2 emissions. Of course, a very easy way of growing that impact is just simply by growing your assets, because then you can attribute a bigger part of that impact to your investment portfolio. So the more assets that are being invested to create positive change are going to have a bigger impact. And this is why we have many of our thematic strategies in place already for many years, and we are developing more and more climate-aligned strategies. So the more capital is allocated towards solution-based companies, that will have a positive impact, and that will create change through signaling, maybe even through cost of capital if there's enough money allocated. So that's important, I think. So it's about the size of your commitment. And then the second is about engagement. We've just started, I mean, we've been engaging with companies for a long time on climate, but we now have started a acceleration to Paris engagement, where we actually say companies that do not comply with our requests, we will actually at the end of the line exclude from our investment portfolios. So we're becoming more and more strict also on engagement, and in the end there has to be some kind of consequence, because you're gonna have to put your money where your mouth is. So those are two elements that I think are very important elements that are part of a good and not a greenwashing solution to combating climate change in the real world.
Thank you.
Can I also add one thing? I think that from the perspective of both companies like issuers that we invest in, but also financial institutions, I think they need to think of this as a human capital issue as well, meaning I think it's important that you recognize if you don't have the expertise in-house to really go to the bottom of understanding transition plans of companies, scenarios of decarbonization, what they mean, what are the implications for your different investment platforms, etc. You need to hire the right people and put the right people in place so that there is some understanding within your company of these issues. It's really important. Look, like my career has been spent 90% outside of the financial industry. I've been at BlackRock 5 years. Before that, I used to do a lot of different things, and I was at Columbia University, for example, right before. Obviously, all related to climate and energy, but I've spent my career outside of this world. And then 5 years ago, BlackRock recognized that it was an important topic and that they needed to bring some expertise, and so that's how I came to work here. And I think that that's an important. Ever since then, obviously, we've seen a lot more profiles similar to mine hired into the financial industry, and I think it has to be the same in the broader corporate world. You just need to bring in this expertise. And the other way is, of course, participating in industry efforts around this. Somebody mentioned the UN PRI, Inevitable Policy Response. We've also supported that. There's a lot of opportunities to engage and understand and educate each other in this space so that we don't represent something that's not, sometimes unintentionally, and fall into this greenwashing trap. I think that's really important. The second thing I'll say is that there's a big reputational risk to greenwashing, and sometimes, and obviously for large asset managers such as ourselves, we feel like we're always, and rightly so, by the way, under the magnifying glass and under a lot of scrutiny, and I think that's important. We'll continue to see a lot of pressure, I think, from civil society and from regulators around not misrepresenting specific characteristics of products, the right labels and things of that sort. So we'll continue to see evolution in that space, and it's really important that that pressure continues to exist, because we gotta make sure that we carry the real world in this transformation.
Okay, thank you all. We have run out of time, so thank you Marion de Marcillac, MSCI, Maja Zanderbergen, Robico, and Laura Segrafredo, BlackRock. Thank you. Bye.
Thank you.
Grazie a tutti. Ora